Equipment. Well, equipment, these costs include all expenditures related directly to the acquisition or construction of the equipment. You see a theme here, right? Any costs necessary and specific to get it ready for its intended use. So this is the invoice price, right? Just the price. We always start with the initial price minus any cash discounts or any other discounts. We add in freight in. So if you need to get it shipped there, right? So like think about if you have a small business, right? Or just any business. When you buy, let's say you buy, a laptop for your company, what do you get to deduct on your tax return? You get to deduct the cost of the laptop, you get to deduct the shipping, you get to deduct the sales tax you paid on it. So it's the same sort of process here, right? Same sort of process. Installation charges, sales and federal excise taxes, and possible construction interest. We talked about that a little bit before. Think of it in that tax example, right? Trying to give you real world practical examples that you might relate to better. Assets constructed rather than purchased. Well, maybe you don't always buy something. You try to construct something. I myself trying to put some PVC pipe together later today. Going to make a little flagpole out of it. We'll see how that goes. But I am not a business, so I'm not going to be capitalizing any of that. Assets constructed by the business for use in its operations. Cost of self-constructed assets include costs of materials, labor, and overhead, pro rata portion of fixed overhead, interest costs during construction. We see this over and over, right? We're seeing a lot of the same points here, and that's good. It'll really drill it down and make sure you know it. Here's a handy little graphic here. Well, we have, all right, well, do we expense it? Do we capitalize it? Do we reduce accumulated depreciation? What do we do? Does it increase the life, right? Is it an improvement or replacement? Does it increase the life of the asset? Well, then it goes on the balance sheet. We reduce accumulated depreciation. Generally, additions that increase the quantity, right, of the value of the good, it's going to be capitalized. So let's say, I'll give you examples for all of these. Let's say we are going to make a significant improvement that increases the useful life of the asset. We're going to reduce accumulated depreciation, and that thus will increase the net book value, the carrying value. Does it increase the usefulness? Because of this improvement we made in our machine, maybe we can make more shoes. It's let's say a shoemaking machine. Now it can make 20 shoes an hour instead of 10. We are going to capitalize that cost. Ordinary repairs, we expense. All right, we talked about that. Just you coming in, get a monthly repair guy coming in, he fixes it. That's expense. What about extraordinary repairs? Well, similarly, as we see up here, if it increases the life of it, we're going to reduce accumulated depreciation. And if it increases the usefulness, same thing, right? Capitalize. Awesome.